Next level up, I have what I call just Series A, Series B, etc. These are higher levels of money. Say if you have the founders putting in, say, $100,000, friends and family 100 more. Angel and seed money typically might be $300,000 to $500,000 in what they call a raise. So if you want to raise $300,000 to $500,000 and it's your first outside money, angel or seed money, that would be a good fit. Series A and B money probably is in the $1 to $2 million range. A very, very high level of investment, but by then you have a significant customer base, and people can see, at least have a much better idea if you're going to make it or not. Customer validation is critical, and if you go out for angel money or Series A and B money, people are going to want, the investors are going to want a lot of documentation on how successful you've been with customers, how many people you're getting as a customer, if you're doing a subscription service, how many people repeat, how many people cancel after the first year, how many people are referring to others, what's word of mouth, what social media say about the products. All these things kind of funnel into what people think about your customer validation. Next level up is venture capital and private equity. Candidly, most angel investors and Series A, B investors really hope the business is sold before you go towards private equity and IPO. Business starts out, they've made maybe 20 or 30 times their investment in that one home run they're trying to hit, and they might get bought by a bigger company. It's called an exit. And if you can show a successful exit on your company, you'll probably have a lot easier time getting investment in the future. But if you want to continue and grow the business, you're probably looking at venture capital or private equity. And they're in big money. Those are typically in $5, $10 million and higher investments in an ongoing business. Again, they really do expect it to be a fairly successful ongoing business. And then finally, you might look at IPO, the initial public offering or public markets. The vast majority of companies will probably never see an IPO. You hear about a lot of them. There's 6,000 businesses or so on the NASDAQ, but there's tens upon tens of thousands of businesses that get bought every year privately because they don't go public. It's very expensive. It takes a lot of mind share away from your senior management. It might take them months and months offline from selling and making the business successful to worrying about how to sell our stock in the public markets versus having a private buyer come and buy you. A quick note, there's a lot of discussion now on crowdfunding. And in fact, if you look at angel groups, there are a large numbers of members, maybe 50 to 100 members in an angel group. When you appear to the angel group, you have a previous relationship with those investors then. So crowdfunding really has two channels to it. One is if you're looking at accredited investors, and that means are you going out to a general solicitation, but still looking at accredited investors. And there's a number of crowdfunding platforms. There's probably a dozen I can think of offhand that you can plug in your documentation, and people around the country, around the world for that matter, can potentially make investments in your business. Caution though, once you go general solicitation, a lot of angel groups and other investors won't want to talk with you. They don't like the crowdfunding, the general solicitation. The SEC is developing rules, and they've been developing them now for a couple of years, on unaccredited investors, small investors, and their ability to invest in private businesses. Thinking about that, if you have an accredited investor and they know they're going to lose 9 out of 10 bets, they're sophisticated investors, they understand it, and they move on if a company goes out of business.